Everyone, it's Ben here, and today we're going to be going over a DCF for Berkshire Hathaway. And, recently there was some news that Charlie Munger passed away, and so I just feel like it just brought the company to top of mind for me, and I was just thinking like maybe it would be interesting to try to value the company. And as I was looking into the company, I realized how complex it was and how this video and valuation is going to be pretty different than almost any other company that I've built a DCF so far. And we'll kind of discuss like why that is. But going over the agenda, so I'll quickly kind of go over an overview of Berkshire. Then I'll discuss today's sponsor for the video, Wall Street Prep. And then what I'm going to do a little bit differently in this video versus other ones is build out a revenue and OpEx build, but it's not going to be actually super, super complex. You guys will see why, but essentially the company that breaks down its revenue and operations in its income statement. And so as I was looking into and preparing for this video, I just saw that it was kind of neatly laid out. So I just thought like this provides an opportunity for us to build that out separately. Then we're going to build the DCF. And for this, what's interesting about Berkshire is that they don't provide quarterly earnings. They just have like they don't have quarterly earnings reports where the CEO, CFO, and all of them like go on a call with investors. There's very, very, very little analyst coverage. So what I mean is there's very little equity research for them. So for example, JP Morgan, Morgan Stanley, all these like bulge bracket banks that have large equity research teams, they don't cover Berkshire Hathaway, even though it's one of the largest companies in the world. And I don't know exactly why, but anyway, because of that, we're going to just build this DCF based off of historicals instead of using analyst estimates, which if you've been following any of the streams I've done in the past for these videos, we've always done a street-based DCF. And I think given what I've seen as I was preparing for this video, the DCF may not actually be super what's like interesting about this video, because the interesting thing about Berkshire Hathaway is that it has this huge stock portfolio. And so after we do the WACC and mid-year convention, we're going to look at the stock portfolio of Berkshire Hathaway. We're not going to do anything too crazy. We're just going to see what is the value of the stock portfolio, and we're going to have to add it to our DCF in order to get our ultimate price for Berkshire Hathaway. So it's kind of like we're going to look at all the cash flows from the actual business and then add the stock portfolio valuation to get to our total equity value for the company. And that's how we're going to get to our price and discuss our price. So going into the bull versus bear case. So obviously one of the GOAT investors, if not the GOAT, Warren Buffett, very, very strong leadership. And he has been doing this for many, many years. Has a very, very strong track record. Second, very diversified portfolio. If you guys know anything about the company, there's just so many different businesses within this one business. So this provides like a natural hedge. And I think what's also talked about a bit less is that some people think that because the company is so diversified, there could be potentially something interesting with unlocking value by selling off and carving out parts of the business and making them standalone businesses. And the original holders of Berkshire Hathaway would still be able to gain exposure. So let's say, for example, their insurance business or their railroad business is like spun off into a separate public company. Then as an original shareholder of Berkshire Hathaway, you would own shares in that new company if it was public. And then third, for the bull case, just robust financial health. I think it's been on the news quite a bit that the company just has a ton of cash, and we'll look at the balance sheet later. And the bear case, so Charlie Munger just passed away. Buffett, obviously very old as well. So you never know what's going to happen when these huge giants and leaders just pass it on to the next person, and you don't know if the company is going to be able to sustain itself well. I think everyone knows that this was going to happen soon, like within the next, or was eventually going to happen. And relatively soon. And so, by that I mean the CEO's departure or the top leaders' departures. And so it'll just be interesting. But yeah, we'll see how it goes. Like when Steve Jobs passed away, he handed it off to Tim Cook, and things have been going well for Apple. So it doesn't mean that the company is going to go down by any means. Next, large size will make it increasingly harder to generate outsized returns, and this has been true for a while. When you're a larger company, it just gets harder and harder to have like higher growth rates. It also very much limits what you can actually do in order to grow. You're going to probably need to purchase like really, really large companies, make huge investments, and it's that pool of investments you can make is like pretty small. Next, underperformance in bull markets. So Berkshire Hathaway tends to not perform in bull markets as well as, let's say, like the hot tech companies. And this is both a good and bad thing. But right now, I'd say we're kind of like in this like wonky, but there may be a potential recession, but we're not like in a full recession yet. At least it kind of seems that way. And the stock market's like not crashing. So when the time comes that there actually is a bull market, because I don't think we're in one right now, there could be kind of like underperformance for Berkshire stock. So notes and reminders, this model will be available for free after the stream ends. It's going to take some time actually to get the link ready. So if you're trying to download this, I would look for it on Monday, the December 4th or so. It should be available then. If not, then the 5th. This is also going to be a high-level DCF based on historicals and not financial advice. So I say this a lot in models when I'm doing these streams for the models, but it's not usually when you're building a DCF, you're going to want to, and you're doing it because you're actually going to invest money, then you're going to want to have a lot of research for every single assumption and build out a lot of different, or build out your assumptions very thoughtfully. And for us, I just want to provide something where you can have like multiple different scenarios, and based on what you believe, it'll capture like a range, and we'll look at that range to see what is like kind of a reasonable valuation. Next, there's some financial statement, Excel shortcut, DCF tutorials and stuff. Those videos in the description below. You can also check out the live tab on the channel for more DCFs, and let me show you what I mean by that. So if you go to my channel at Rare Liquid, you can see on the live here, there's a bunch of the DCFs, and I just feel like it's an easy way to look at past ones if that's what you're interested in. Let's see what's next. Oh yeah, so also working on an investment banking course. I think around Q2-ish of next year, it'll be ready. I've been working really hard on it. But that's kind of the situation overview. I guess I forgot one thing also. So let's see how the stock has been doing. Oh, I think also one important thing to go over in case you're not familiar with it is that there's two classes of stock, class A and B for Berkshire Hathaway. And this is not like some glitch. It's actually one share is $542,000. And that's because Warren Buffett wanted to kind of show, I think this class of stock kind of represents his philosophy of value investing, of if you just buy and hold of a really, really good company and you just hold it because you believe in the management, you believe that the company will do well for a long time, then the value will just keep increasing. And instead of doing stock splits like many other companies like Tesla have been doing in order to make it more palatable for retail investors to be able to buy shares, this guy just was like, no, screw it. I'm just going to have one share I'm never going to do stock split, right? And I believe he had that philosophy for a while, but then I don't know exactly what changed his mind, but he decided to issue Class B shares. And these shares, hopefully a chart comes out, but price maybe. I guess that chart's not coming out for whatever reason, but you can see here it is a separate class of shares, and this one is like right now $357. The difference between the two is that Class A shares have much more voting rights, and Class B has much, much less. So you pretty much still get the exposure to Berkshire if you buy this Class B stock. But then if you were trying to like influence the company in some way, like hedge funds try to do, then you would not want this. You would not want Class B stock. But you know, if you have like very few people I know have enough money to buy one share of that's cost like $542,000. But let's go back to the stock price to see how it's been doing. Seems like it's been somewhat in the upward trajectory. So I guess that's good. I mean, it's near pretty much its all-time high. So yeah, I guess pretty good performance. Okay, so let's see. That was Berkshire situation overview. Next, I want to briefly discuss our sponsor for today's video, Wall Street Prep. And they have a very interesting buy-side financial modeling course that I actually, once I finish my MBA program, I have 6 months left or so. I actually want to take this course myself. I think it'll be really interesting. So it's taught by an experienced hedge fund professional named Brett Cawthron. And just going through his LinkedIn, I was going through it earlier because I was curious. But he has a lot of really great experiences. So Greenhill was an investment bank that back around this time was much more reputable. To be honest, like right now, it's not as reputable. But back then, it was one of the top companies, one of the top elite boutique banks. Then he worked at Maverick Capital as a managing director. I don't know too much about this firm, to be honest. D.E. Shaw, Citadel, Two Sigma, Schonfeld, I have heard about. My friend works at Schonfeld, and it's like a healthcare focused hedge fund. And it from what he's told me, it performs pretty well. But obviously, he just seems to have a lot of really, really great experience. And he's built out this course that goes over process-driven investing, buy-side model construction, analyzing a business, you know, all this stuff you guys can check out using the link in the description. And if you're interested at all in hedge funds, or you're in asset management, or you want to go into the buy side at all, then, you know, and obviously even if you're like interested in private equity or something, like all of this could be very helpful and interesting. You can like learn how to build revenue models, learn about business momentum and how to factor that in. And here's like a little bit more. You can like go into the table of contents if you want. You can see it's very extensive, tons of different topics. So feel free to check that out if you're interested. Everything's linked to in the description. And with that said, now it's time to actually build the model. I'm going to pause real quick to see the chat to see if you guys have any questions. Have you ever thought of doing a pitch deck after doing evaluation? I think if I was interested in doing pitches, maybe, but I don't really want to spend the time and effort to do that for pitch competitions right now. Are you using your ThinkPad X1? Yes, it's a ThinkPad X1 Carbon. And would you recommend learning SAS? Not sure what SAS is. Financial Edge or Wall Street Prep? So I've worked with both. I personally, right now, only work with Wall Street Prep. And I think what I liked about Wall Street Prep is that they provide, let's say just for like their financial modeling course, you actually go through income statements and then build out a model as you dig into the financial statements, which is like kind of what I did when I was at JP Morgan. So I think both, you can't really go wrong, but I'd give the edge to Wall Street Prep. Okay, so let's build the DCF. Zoom in a bit. And I also am curious to know what you guys, as I like do kind of this basic stuff, I'm curious to know what kind of videos you guys want me to make. And it doesn't have to be about modeling. I'm curious about like anything banking related, finance, MBA, anything you guys want to see. All right, I'm gonna steal a little bit from my Google DCF I made so that I don't, so I save some time essentially. What I'm gonna do, copy paste that. All right, so we have our switches. I'm just going to delete all the information. Berkshire. Okay, and today's date is the 3rd. You're in 12/31. Man, can't believe it's almost 2024. It's crazy. Okay, and we'll use this later. All right, so as I mentioned, I did look into Berkshire Hathaway a little bit, and I do want to, compared to the other streams I've done, I want to talk about their income statement a little bit because it is a little peculiar. So a lot of companies, they do have breakdowns, but Berkshire Hathaway has like completely different like businesses, right? So they have their insurance company here. They used to have something called finance and financial products, but they got rid of this since 2017. Then they have railroad, utilities, and energy. And then they also break down the costs for each of these segments. And it's not just your COGS, your cost of goods sold, but also your operating expenses. So that's why I was like, okay, for this, maybe we can build out a revenue build, like just a small revenue build and cost of goods sold and operating expenses, and we can essentially just have a lot more flexibility as we model for our EBIT. And the other thing I wanted to show you guys is this was like something I just did not really know at all. There's, and I mentioned this at the beginning of the video, there's basically no broker or equity research coverage for this company, which is unintuitive because Berkshire is one of the largest companies in the world, and when you're a really, really small company, you don't have that much coverage because it's like, who cares about this tiny no-name company except small cap investors maybe. But once you're really big, then it's like, oh, there's a ton of interest. And so equity research analysts, if they build models, if they write reports, they can sell all of that to investors and make a ton of money, right? And so there's a lot of incentive to cover large companies. And almost all of the largest companies in the world, just showing an example, let's look at like Apple. Look at how many brokers they have. They have like 30 or plus, right? Berkshire Hathaway obviously is smaller, but it's still like a 700-something billion dollar company, and they have like these no-name equity research and it's like they pretty much just have one that provides a rating, or sorry, a target price. So basically what that means is that we're going to, the reason I'm bringing this up is like, I'm going to be looking at historicals. And since Berkshire is such a stable company in quote unquote boring industries where growth rates aren't like crazy, we're just going to be looking at we're just going to look at historicals and try to project from there instead of looking at street estimates, which is what we've done in the past. And one last thing I'll mention before I start building the model is actually two more things. One last thing, or 1 second to last thing, is that their balance sheet is very interesting. So if we go to their latest quarterly earnings and then we go to the company's balance sheet, first of all, they've broken it down into insurance and other and railroad, utilities, and energy. So it's like there's similarities with their income statement and their balance sheet. But still, this is not like super common. And you can see here investments in equity securities. This to me is, this is their huge investments in other stocks like Apple, American Express, Coca-Cola, etc. So I just thought that was interesting. What was I going to say? What was the other thing? I can't actually remember. I'll bring it up when I remember. Okay. So, all right, let's start looking into all this. I'm going to start from 2018 just because 2017, we have these financial products and all that, and it's going to get messy if we try to start from there. So we're going to build out the revenue build, or let's just call it Revenue build. Okay, let's call it that for now, but I might change it because we also need it for our cost of goods sold. So let's look at how they, so insurance and other. And then there's railroad, utilities, and energy. Okay, so I'm just going to link first to the revenues. Okay, and then as I mentioned in previous streams, it's always good to color code your models because then it's a lot easier to audit for yourself and for others. And there's always a color code at every bank. For JPM, it was green if you link to a separate tab, black if you're calculating something, red if there's like an anomaly, purple if you're linking to the same tab, blue if you're hard coding. So you guys will see as we build this out. I remember now what the other thing I was going to mention. So because we're relying on historicals instead of street estimates, a lot of people have asked in the past, like, oh, what if you don't have FactSet, which is where I downloaded all this information? Like, how would you build a model? I guess this is like an example for that. You could go to bamsec.com or Yahoo. You can get all of this information and download it into an Excel and then build out a DCF, even if you don't have street estimates. Yeah, I see a comment. Nearly impossible to model Berkshire, isn't it? You'd have to value all the subsidiaries to value the company. So yeah, that's what I'm interested in. Like, we'll see if like maybe the price I get to is just like totally off, and yeah, we'll see. But as I mentioned at the beginning, what we're doing is we're gonna later add the stock portfolio, all the investments that have been made, because I think a lot of them are in, almost all are, or actually I don't know how much, but a lot are in public companies. So we can just get the current stock price and number of shares and then add that to our equity value that we calculate. So, or the implied equity value that we get. Ooh, Ryan from Philly. What's up, Ryan? Okay, and then another question. Is finance adopting any major AI? Actually, I do think so. So, FactSet, this company that I used to use back at JP, and is, a lot of people use CapIQ, FactSet, and Bloomberg. And FactSet recently reached out to me saying like, hey, do you want to check out like what we do with AI and everything? And I actually didn't get to setting that call up, but I probably should, and I can let you guys know next time. I think a lot of, because finance is such a big industry, I bet there's a lot of companies working on AI stuff. Wouldn't you have to value the private subsidiaries too, since Berkshire is decentralized? Yeah. Let's take a closer look at that later. I didn't look into that part, but a very, very fair point. So we'll see. Well, let's continue building the revenue build, and then we'll we will later look at the private investments. Like maybe we can just pull something from the balance sheet. Conservative, base case, and optimistic. It's pretty standard from previous streams. It's indented a little bit. Okay, so let's, what I want to do here is look at the growth rates. And as I mentioned here, make it black when you're calculating something. So this is interesting. Now that I think about it, I do want a few years more. Let's get at least 5 years. All right, so let's see. Or before I make some comments, let's look at railroad, utilities, and energy. So I think that the reason, or this is, I think, probably fairly obvious, that during COVID, there seems to have been like a huge disruption to the company. A lot of things shut down. So railroad, utilities, and energy. This is like a mix of things. And energy went down quite a bit during COVID, and then like shot back up. Insurance, actually, I'm not as like familiar with. But then, either way, the company, all these businesses eventually grew. Were able to like get all that growth back in 2021, and has been doing decently well in 2022 as well. So, what you want to normally see if you're just making a DCF off historicals is like some sort of pattern, but there's like this huge anomaly, right? And I think this growth rate is a little bit too high, and it's just because it fell so much the previous year rather than like the company just growing so much. And actually, I should also check how much the company's growth is from M&A. Let's see if there's information about the company's acquisitions. Deal count. Okay. So there seems to have been $3.3 billion acquisition in July. Travel centers. 3. Oh, there's a lot of acquisitions, but it seems like it's because the company has like so many subsidiaries. Made a huge acquisition in 2022. Okay. So my view is that 37 billion out Southwest, rumor. Okay, interesting. Okay, so it seems like at least for some of 2022, 2023 revenue, it's not organic. Like some of this revenue growth is coming from the acquisition of companies, and you're just, combining income statements together versus actually growing organically because you're just gaining more customers and all that, right? So with that said, I'm just trying to think about what I want to do for here, and what I think makes sense is basically taking some type of average from the past 5 years, because it is still instructional, but then having like a bit of a haircut from it and then slowing it down over time. And even though obviously the growth rate has been very bumpy, right? It's like positive, then it's going down, and then it's negative, and then it's like shoots back up. Normally for companies, as you go larger, you just imagine intuitively that the revenue growth rate will go down slowly over time, because as a company gets larger and larger, it's harder to grow, right? But given like acquisitions and then like COVID and stuff, that's why like things are pretty wonky. But if you just kind of grow it down over time, then you're kind of just implying that, some years might be a little higher, some may be a little bit lower, but on average, it'll kind of like be at a certain rate. So that's pretty much what I'm thinking here. And it's not like the growth rates are like 70% and 20% and then 50%, right? So, and like negative 20%. So I think like it's okay to take an average, given that things aren't like absolutely crazy here. So, and I also think that averaging out by including like this negative number, which is uncommon, and the super high number, I think it makes sense. So maybe in our base case, we just assume simply average of past 5 years. And then 5.5%, like, I think, one thing I said we were going to do is look at quarterly. So this will be actually very instructional for 2023. So yeah, I think this will be better for that first year. So let's, basically what we have here is, these are the quarterly figures for the company for 2022. And then we have the quarterly figures for 2023. So then let's take a look essentially how the company has been growing for these segments in 2023 versus the same quarter last year, 2021. Right, so there's 8%, 4%, and 7%. And then if we average this out, it was growing at around 6.2%. So throughout 2023, basically what this is saying is that the company has been growing at around 6.2% on average. That's actually kind of close to the 5.5% we have, but I do like taking from actual figures from 2023. So what we'll do, it is interesting. Quarter 4 is not provided, maybe because the company just provides. I don't know. Actually, it's kind of weird to me why this is not populating, but I think it makes sense to kind of link to this 6.2%. I'm gonna try to make it a little bit more like not as just randomly somewhere. I'm gonna label it correctly and stuff. So here we're gonna calculate quarterly insurance and other revenue growth. And then we're going to do quarterly railroad, utilities, and energy revenue growth. Did I do something wrong here? Okay. And then for utilities, energy, all this stuff, let's see what we get here. Whoa. Huh. That's humongous. Okay, I'm going to double check this with the latest quarterly filings. It's because I'm hoping FactSet didn't provide me like with weird numbers. So you can see here, this is like the most recent quarter of 2023, and then also provides like the past 9 months. So insurance and other total revenue, 9 months, there's like a $12 billion difference. And then railroad, 75 versus 39. Okay, so there was a huge jump. And I'm wondering why that is. Let's see. Okay, let's see what happened with our DCF here. So 52,149 is 2022, which is here. And it's been growing kind of like steadily. it just seems like the company acquired something. That's why it jumped so much. What kind of company is this? Reinsurance company, so that's insurance. I'm just like hesitant. So let's say, so we discussed using this like as an average. And obviously it will be growing by this like 91%. It has been over the past 9 months in 2023. I'm wondering what made the revenue jump so much. Utilities, energy. So I'm just going to Google Berkshire Hathaway. I guess it would have been in like 2022. Or let's just look at railroad, energy, utilities, jump revenue. Yeah, so this is the kind of thing that would be in an earnings call, but then, Berkshire only has an annual earnings call. So now, and I'm just trying to see if there's like something from the news that explains what's happening here. Otherwise, I'll have to dig through the Q3 earnings. BNSF saw a 15% decline in earnings, and that's their railroad. Okay, might have to just dig into. Okay, so railroad, utilities, energy. This is stable. This is a huge jump, and that is stable. So it's definitely coming from utility, and right now I'm looking for what caused that huge jump. This, by the way, is also very common in when you're in banking. You have to you see weird things happening financially, and you have to like kind of get to the bottom of it. 535, and there's like various ways to kind of search around for it. Usually, it's helpful when the statements like have a lot of information, but it seems like the quarterly earnings report does not. What it seems like for me right now is that they probably acquired something that's like a utility and energy company. So Berkshire Utility, or maybe it was energy acquisition 2022. Oh, maybe 2023. Okay, so Cove Point, 50% limited partnership, etc. Matters how big this company is. So it seems like it might be 3.3 billion. Okay, I see in the chat that it says it's Oxy. I have heard of Oxy. So let's see, Hathaway, Berkshire, Oxy acquisition. Boost stake, 520 million. I think it was a lot smaller though. So if this came out on August 2nd, let's see, and then this came out in November. So I believe it should not show up in this one because it's before. Go to income statement, utility, Okay, no, it still jumps 14 billion to 9. Okay. I mean, it would make sense if it was pilot travel centers, but is that which section does it go into? Oh. Okay, so it's like travel. Utility and operations. Okay, I think it seems like this acquisition might be it, but let's see if it provides any more details. Where it sells diesel. Oh, pilot operates travel centers and has over 150 retail locations in Canada where it sells diesel fuel. Okay. So originally it didn't sound like an energy company, but it is. Amongst its business activities, Pilot operates large wholesale fuel and fuel market. Okay, this makes sense. We're not 5.5 billion, 83 million, equity method, blah, blah, blah. All right, so that makes way more sense, and it also makes things a little bit more tricky for us. So going back to these numbers here, this huge jump is because as this company does quite a bit, it like gobbles up a lot of companies, and then that's like how the company grows its like revenue. A lot of times it's very acquisitive. So, but the point is, like here, I think for 2023, we can follow the growth rate here of like 6-point-something%. Like I don't think it's going to be that much different than this, like maybe plus or minus a bit, but we'll have the range here. And then 2023 for this is going to be a little tricky, but it grew 84% here, 105 here, 85 here, and 91. So I guess it'll probably just grow at that rate again, unless it was already applied in Q4. Let's see when it was acquired. January 31st. Okay, so that means Q4 of last year will not have been affected yet. So this year that we will see that huge jump again. So I'm just going to go with that 91%. But then what we're going to have to change in future years is that obviously the company is not going to grow at 91%. It's going to grow at these historical rates and potentially even less because the figures are going to be even higher. It's harder to grow faster. Okay, let's try to speed things up because I know we've been kind of looking through a lot of this, or we've been kind of moving slowly, but wanted to, I needed to understand some parts of the business. Okay, so what I want to do now is going to be like relatively simple. We have 2023 here, and we only have 3 months that we're not really accounting for because it's almost the end of 2023. And for a DCF perspective, we're actually just going to pretty much take like a month's worth of free cash flow, and then we're going to take 5 years worth of full free cash flow. And so, this is more representative of a 5-year DCF versus like not doing 2028. So what we're going to do is just simply grow this down to certain figures that are like somewhat reasonable. I think in a base case scenario, in 2019, the company grew, 3%. I think something like that is not too aggressive or too conservative. So let's say that revenue 2028 here, let's grow it to 3%. Then our optimistic scenario, let's grow it, actually, yeah, 3%, maybe 2.5%. And then in our optimistic scenario, around like 4%. And then our conservative scenario, just like 1%, or yeah, 1%. Let's see how that looks for now. So we're going to get our previous year, subtract by the difference of our 2 years here. Should not use the mouse. Okay, so we get that, and then divide by our number of years. Oops. So since this was connected to slide, I'm going to make into a cell in this sheet. I'm going to make it purple. This is going to a different sheet, so I'm going to make this green. Okay. Oops, I chose the wrong green. Okay. And then for 2023 and 2020, yeah, as for this, I think it does make sense given that we're not using analyst estimates. We don't know exactly what's going to happen to make things a little bit more conservative and optimistic versus in other streams. We did not really care about 2023 that much. So let's call this revenue 2023. And I think, let's see, we grow this down by, in the conservative case, we grow it down by, let's say 20%. In the optimistic case, grow it up by 20%. Let's see what that looks like. So that times 1 plus. Okay, I think this conservative case is pretty unrealistic given that it's already grown this much in an optimistic scenario. But I guess this just accounts for like maybe there's much less growth in 2024. So, you know, if you're building this model and you have studied Berkshire Hathaway a lot and you have like, I don't know, a lot of information, then you can adjust these figures once, you know, you build your own model or you use the model, this model if you want, because it'll be available to download. And then let's see, for all these figures, we're going to use pretty much the same process. And while I'm working on all this, I'm curious to know where you guys come from / why you guys like watch these videos, because I may have mentioned this in previous streams, but when I first streamed like my first DCF video, which I think was for Netflix, I didn't really expect anyone to join, but then I was like, I want to build a DCF anyway, so I'm just going to do it and might as well just stream it as I build it. And then it was a little bit more, you know, there was more interest than I thought. So I'm curious to know, like, for the people who've joined today, what are you guys joining for? And normally well, this might not be obvious, but on the job, you're always told never use your mouse. This is a one exception where I do use it, because when I copy paste this formula down and then I would have to go back in here and like adjust the cell like rename the cells, and actually that's doable, but I just prefer to use the mouse. I think it actually is a little bit faster for that particular action. All right, so let's take a look at what, let's see what this looks like. So okay, so essentially 5 going down to 1, 6 going down to 3, 7 going down to 4. I think, let's think. Conservative case seems pretty conservative. Just like looking at some of these growth rates, and it also kind of implies that, it implies, I guess, like, let's say a more organic growth rate, I think, because as the company grows more and more, I don't think it's going to be like growing that much more organically, because their businesses are so mature. And so this like is pretty conservative. Base case, I think, is more just like reasonable. It does feel pretty reasonable to me for the company to be growing at these rates a little bit faster than the U.S. economy GDP, which is usually around 2.2 to 3%. And then optimistic scenario kind of includes a little bit more growth, and it's kind of high in my opinion, given these like previous rates, and obviously how these have like some acquisitions in there. So that makes sense to me. So revenue for insurance, let's call it, for that switch, and we'll have a switch for railroad, utilities, energy. So offset. So reference the cell that you're in, and then you go to the switch, anchor it, column 0. Did I mess up somewhere? Okay, then copy paste this across. And then we're growing by this growth rate, 1 plus your growth rate. All right, so now we got our insurance and other. Now we need to grow our railroad and energies. So this is going to be a little weird. So okay, revenue 2023. This is for, I think on the job, actually, I would probably, this is like the normal way I organize my assumptions, but I think I would try to think of doing this a little differently. Let's see. I just don't love the way that it's organized, some of this. But whatever. Okay, revenue for, I'll just call it I and O for insurance and other. And then we're going to need this for railroad, utilities, and energy for 2023, and then also for 2028. Okay, but I see. I just want to check in the chat, see what you guys said here. So you're from Israel, go to University of Waterloo, and you're studying. You're a student, quant trader from Canada. That's interesting. Finance and accounting student. Okay, cool. All right, so for 2024 onwards, for our base case, historically, seems like not as reliable versus our insurance revenue stream. My guess is just that these industries are quite cyclical, except for utilities. Energy and railroad really depends on energy. Energy just goes like, it just moves in cycles. Utilities pretty flat. Railroad depends on the economy. So like these things are not always the most steady versus I guess like insurance is like you have recurring revenue streams and it's a little bit more steady, which is why I'm thinking that these growth rates are the way they are. So try to think about how to actually grow this. So in the first year, let's just do a similar thing. It's negative 20%, above 20%. Maybe a little high for this one. Let's see what it looks like. So this times 1 plus our growth rate. That times 1 plus our growth rate. And then 2028. Okay, so 2024. Let's see what the average looks like for the past 5 years. 5.7%. Okay, so steady growth there. Okay. Average 5 years around 6%. And honestly, that's like not that bad. Like I think if we are doing average 3 years, it's a little higher, which I don't love. So I'm gonna go with that. I'm gonna go with an average of the past 5 years. Reasoning is just that this 15% being really high is due to COVID. This year being really low is also due to COVID. So these kind of balance each other out. There were acquisitions being made in this year, so that's why this is super high. Over time, like as this revenue base is larger, I think it's going to be harder to grow. So I think we want to be a little bit more on the conservative side. So rather than taking these 3 years, we could take these 5 years. And I think this, if I had to guess, I would say next year, I'd be surprised if the growth rate is 6%. I think it'd be a little lower. So what this means for me right now is I'm personally thinking maybe I'll use the revenue growth for the insurance and other for the base case, and then be a little bit more conservative on the railroad, utilities, and energy based on like these historical figures and the way we're projecting. So let's do for 2023 and 4. Okay, this is a little bit odd. Okay, I think if I were to try to reimagine this whole assumption section, it would take me a long time. So I'm just gonna think about it after the stream, maybe, and then maybe incorporate it in a future video. But because like this, the way I built it right now, is pretty it's not always how I used to build it at JPM, basically. So okay, let's see. We need one for separate for 2024, or do we do it by 20%? Okay, let's keep 2024. Let's just build it separately. Oh well. Okay, so also just as like a personal preference, I like having this be percentage or, oops, yeah, percentage or wait. Okay, can't use a mouse, sorry. 0% or 0% like this. Okay. All right, so growth rate, let's see what it looks like. Negative 15% here, and then positive 15% here. Oops. So growth of 5, 6, 7%. So around 4.9, 5.7, 6.6. I think that's pretty fair. So last year in a more, I believe, steady state, the company grew at 8%. Just acquired another company. It's going to be a lot larger. This 110% feels a little big. Yeah, I think that's a little bit too optimistic. I'm going to lower this to 15% as well. And lower this as well. Okay, but I think this is relatively fair. And because I mentioned briefly, like red means that you're doing something that's like an anomaly or weird, and that's what this is an example of that, because the rest of this are going to be like calculations. So since they're kind of growing similar-ish rates, so I think we'll have something similar where for 2028, let's call it 2%, and then 0.5%. And then here, 3.5%. So basically just like 1.5% difference on each of these. And I might change it, but let's see see how it looks. So to calculate this, again, get your previous year minus 2 open parentheses, the difference between your the previous year minus your last year, divide by the number of years. Oops, forgot to add another parentheses. Okay. Wonder if there's a way. I think actually there's a way I can just copy paste this down if I anchor this correctly. So it needs to be in the same column, not the same row. So column L we anchor, but row we do not. This should allow me to copy paste it. Oh, yep. Oh, wait, no. The previous year also needs to use same 2024 L30. To be same column but not row, and this. Oh, I need to copy paste this across. Cool. Just don't need to use my mouse. All right. Where are we at? So we just got our revenue. Just doing a final audit to see, does this all make sense? Let's build it out a bit more here first. And once we do this, we're pretty much, once we finish the revenue build and the OpEx, we're pretty much, that's like almost our entire DCF, because we're not going to be really sensitizing for the cash flow items. I took a look and they're pretty stable. So this is just going to be the longest part of this entire video. Okay, so it's growing. Whoa. Railroad and utilities. This year is going to be at least 75 billion. Just double check that. Railroad and utilities, 75 billion. Huge jump. And then, so rest of the year, you add more to that 75 billion, about $100 billion business. So this is becoming a huge part of the company. And growing from what it was here to 105 billion, 10, 14, 18, 120. Okay. Yeah, I think by 2028, yeah, unless I guess something really bad happens. This is not, I'm just always trying to not be too aggressive. All right, like I think it's okay to be a bit conservative with your projections, because then, you're kind of inherently building margin of safety. So I'm just thinking that we should not be too aggressive. And let's see, the 6% here, 9%, 1 minus 1% minus. We're at 9%, then -1, -4, 15, and 8. Then it just acquired this company. So what I'm actually thinking is decreasing this year in 2024 a bit, because the average is around 6%, but this growth rate is fake. This one actually might also somewhat be because of an acquisition. I personally want to add a small haircut here, and this is like pretty bad practice, but to hard code. But I just want to decrease it by 1%. I think this makes me a little bit more comfortable, because it will be a huge business. Also very cyclical, so you're going to have a lot of up years, down years. And as you can see, it's like red. So people, this is why you want to provide color coding, because then, you know, someone sees something red, they'll look into it, and then, you know, it'll be like, okay, this is weird. But typically, the best practice, actually, why don't I just do best practice? You want to like have your assumptions all here and like link to them. So why don't we just do it here? -1%. And the reason you want to do that up there instead of, you know, within a certain cell down here is because you can always look at these and make changes, and you know that these are like what's driving everything. These down here, for the most part, are kind of like all just like formulas and stuff like that. And so like you should be changing these assumptions and everything should be changing in the model, versus like you actually going into any of these individual cells and like changing things in order to affect the model. So it's best practice to have like everything in all the things you would change in a model in the assumption section. Okay, but so 5% down to 2%, 4%, this seems okay now a little bit too high. So let's call this 3%. And this is going down to 2, and this is going down to around 0. Seems a little too low. 1. So 4 goes down to 1, 5 goes down to 2, 5 goes down to 3. Okay, so I feel better about these numbers. And that's pretty much our revenue build. So it's only 2 lines of revenue, but as you can see, there's like some thought put behind all of this. And I think that when you're trying to build something even crazier, then it gets even more complicated. So let's get our total revenue. Then our percent growth. All right, so make this gray and then Alt HBS. All right, so now we have our revenue growth and our revenue build. We're gonna need our operations and expenses, and that's really the hardest part of this whole DCF, and then rest should be relatively easier. So here we're gonna have our costs and OpEx build. It's gonna be a very similar process, but let's just delete everything out. Okay, so insurance and other costs and expenses since 2017. I personally, this is personal preference, but you can either have your negative numbers be negative or have everything in the model be positive and then subtract out. And that's what I prefer all the time. Instead of growth, we're going to look at revenue margin, or sorry, cost margins. So what that is, your costs divided by your revenue. And as you can see here, wait, it seems, yeah, the margins are, at least the insurance business is a very low margin business. They're only really earning 10% in EBIT for each dollar earned. So 10 cents of operating profit for every dollar of revenue earned. What you want to see are some pretty like standard figures. Again, like patterns are always great. I think here, again, 2020 is super odd, so I would consider this an anomaly. It seems like, you know, 27 also seems really high, but it looks like 91% or so is like the average. But again, we're going to look at the quarter for 2023. Well, let's also see what it looks like for railroad and utilities. 2017. Oh, that's revenue. Costs and operating expenses. So from 2017. Then again, percent margin. Okay, this is amazing to see. Like, this is what you want to see. The margins all are within like 2%. So this is like when you're building a model and you're doing it based on historicals, your dream come true. Actually makes me feel a little bit happy. Because it just makes your life easier, right? So, but that can all get derailed because, you know, they made this acquisition, and we'll see how the quarterly looks, or quarterly margins look for 2023. Okay, so how should I do this? Oh yeah, so quarterly insurance and other revenue margins. So yeah, margins. Okay, and I'm also not like capitalizing this correctly and all that, but whatever. Margins. All right, so total, okay, so the costs and expenses for insurance and others here, divide by our total revenue. Okay, relatively stable. And then we want to get our costs for railroad and utilities. Divide that by our revenue here. 90%. Okay, well that ruins everything kind of. Huh. So yeah, so you see this is tricky. Because historically everything was at around like 80, 78, 80% margins, but now it all increased to 90%. And these are like cost margins, right? It's not like gross profit margins. So the higher it is, the worse, because it means that for each dollar you're earning, you're paying more in costs. And that should go down over time because you become more efficient as a company. So because of this recent acquisition, it seems like their margins have gotten a little worse. And now we're going to have to think about how to incorporate this. So I just want to make sure these numbers are correct. Probably zoom in for you guys. Okay. This one will be a little bit easier. So based on the average here, it's like 86%, which is a little bit lower. It used to be 95 to 90%. So essentially they're becoming more and more efficient in this year, which is a good thing. And similar to what we did in previous figures. Okay, first of all, actually, I'm just realizing that these numbers might be a little bit too aggressively high or low. So I want to change this to 15%. 15%. Oops. $2023. Let's make this 10%. Wait a minute. Why didn't that do anything? Oh, wow. Actually, linked to the wrong cell. So it should be row 12. Okay, good thing I caught that now. Okay. All right. So the costs for that 2023 year, again, we're going to link to our average of the past 9 months. You know, I feel like that is pretty fair. And then we want, that's like kind of lower than you, like the historicals. Interesting. Why? It's a pretty big jump. And normally, so what you want to do here is lower your margins over time, because company gets more efficient and you should be able to just have higher margins over time. Insurance and other is typically not a very, like, it's not an industry that changes that much. So I want to just look at previous quarters as well. So previous quarters were like 90, 87, 91, 77, 79. Okay, so this year was 2023 was just like a really odd year, probably because of acquisitions. Like what I'm thinking right now in my head is like, is this company going to go back to its historical averages, or is it going to continue operating a lot more efficiently? And I feel like I read something about that as I was preparing for this. So Berkshire, Hathaway, increase operating income. Yeah, 40% increase was driven by higher earnings in insurance underwriting and insurance investment, other control of the pilot travel centers. Yeah, okay. So this year was just like a crazy year for the company. I remember reading this. Let's look into, hopefully this provides like some information as to why. The Omaha, Nebraska conglomerate saw investment losses of $23 billion last year compared to a year earlier. Generated $2.4 billion, up from a loss of $1.1 billion during the same quarter last year. Insurance, investment income, etc., Geico. So there's no information about what happened here on this article, I think. Forbes. Don't really like depending on Forbes. Investment income was 75% higher, primarily due to higher interest income from short-term investments. Oh. Considerable reduction in advertising expenses bolstered profits. There's actually pretty good, seems like a lot of information here. Okay. Non-controlling business. Oh man, that complicates things. Okay. %, 87, 91%, 77. Okay, this is complicated. So what I'm gathering is that this is a very, very good year for the company. And I personally don't know if it's going to be repeatable for the long-term future. So whereas like normally you would imagine this rate would decrease over time, I think it is more likely to go back to historical averages, at least for this one, which is around like 90, 91%. So I think in our base case, it makes sense to go back to our historical average. And then we can add our cases here. So for 2024, okay, starting with 2023, we'll do similar thing. Here, where 2023 street is insurance cost. Just gonna call it costs. Insurance and other. 2024. Or 2023. What do we do here? Yep. Okay. I'm going to change this a little bit because it's bothering me a little how everything looks. So, and I kind of think if we just have it be revenue. So have conservative, and we're going to want revenue here. This, we can make this a bit of a lighter blue. So revenue, then this can have insurance and other 2023. Oh, hey Andrew, good to see you. Or good to see you on the chat. It's funny because I was talking to Andrew, I think a few days ago, saying like, I'll say hi if he comes to the chat. Comes onto the chat. Okay, but I have year revenue. Oh, why do I have revenue here? We have metric. So revenue. So item. Oh no. So I'm trying to think about this on the fly of like what I would want to make it look like if I was giving this to like an associate. And this probably not exactly would look like this, but I think this still looks a little bit better. utilities, energy. Never call it metric though. A lot of times, actually, also we have the assumptions all in like a totally separate tab. And I just think it's easier to look at when things are at the top for streaming purposes. So that's what we're doing here. So we're looking at revenue here in this current year. Let's just call it. What are these? These are percentages of. Okay, whatever. So I was thinking like it'd be good to call it like growth or. Yeah, growth. But this is like. These are all being used a little bit differently. Based on like some of these we're taking a haircut. Some of these it's like the hard, just like we're growing it down to a certain figure, etc. So I'm just going to call it metric. All right, so we have revenue growth rate, or revenue there, and then let's do the same thing for our base case. This will be for the year 2028. Should all just be the same years. Insurance and other. Okay, no, I think this is fine. So insurance and other. Okay, and then same thing for this. I guess by the next stream, I'll try to have something that I like a little bit more. I see some issues with this one as well. Like, I don't like having these like gaps. There's gotta be some better way to do this. So I'm just gonna, but for now, I think I like this a little bit better. And this is all fine. Okay, and the reason I did it like this is so that basically now we're gonna also have a costs and operating OpEx section. We also need here the year and the metric. All right. So where were we? Okay. 2023, I guess the question is like what are we going to do here for our cost and OpEx? The haircut, I want to so when we're thinking there's like signs that need to be switched for this section, which could get a little tricky if you don't remember. So when your costs and OpEx are going down, it's a good thing. So we want, in our conservative case, for the number to get higher. All right, so it's not really a haircut we're going for here. We're going for like an increase, which is different than over here for revenue growth, where our conservative case was a decrease, right? So let's call it like 10% would be a lot. Let's say like 5% increase, 5% difference. Oh yeah, thank you in the comments. This is optimistic. Okay, so 2023 got nothing, and then negative 5% in the optimistic, right? We're saying like it's going down. So 1 plus that, so a higher, right? And it's pretty much saying like you'll go back to your, actually that's probably way too much, so we're going to change that, but let's just build out the formulas for now. Oops. All right, so these are just like fluctuate way too much, because margins should just be like a lot more. They should be a lot more like stable. So 88% to 86%, 84%. Yeah, I don't. Actually, yeah, it could change like this because we have a quarter left. So, but in this optimistic scenario, like I don't think this is gonna happen. 84%. This is like a huge jump. Personally, I don't think so. But if it's 86% over the past 3 quarters, then I guess it's actually a little possible. Now, the real tricky thing, I think, is like what's going to happen in the future. Given that over the past 5 years, 6+ years, like the best it's ever done was around 90-something%. And it seems like this year is an anomaly. So in my base case scenario, what I want to do is actually just take the what's been consistent over the past 5 years and then use that as our base case scenario. So, and I think like that's kind of fair. So 2024, so this would be for our base case scenario. So first of all, the metric I want to use is average of the past 2 years. I'm not going to include 2020 because that's a COVID year, and these two, like they're pretty much the same thing as that. So I'm okay using just that. And this is going to be 2024 to 2028. We're going to keep it flat. And it might look weird it might seem weird that's like flat, but again, look at this, right? Without this 98%, the rest of it has been pretty flat. And for these like super large old businesses like insurance, it shouldn't really change much year to year. So this year is like crazy weird. With that said, I think we do want to have a conservative case that's a little bit less and a little bit higher. A little bit higher for the conservative case and a little bit lower for the optimistic case. So I think I want to just do something similar. Choose like one number. Growing it to a certain rate based off of these numbers I don't feel like make as much sense. And things will go up and down, so they'll even out over time, right? So let's call it that plus 1%. That minus 1%, 89.4. I think that would be pretty challenging for the company. Oops. I'm making these purple because when you link to another cell in the same sheet, it should be purple. So these margins obviously look really weird, and you, again, just to be crystal clear, normally your margins should be trending upwards or downwards in this case. So your operating margin should be getting better over time, and better means lower because we're looking at our cost margin right now, not our EBIT margin. Said another way, your EBIT margin should be increasing over time. Your operating profit, you should be getting more and more efficient as a company over time. But if you look at this company, it has increased from 95% to 91%, but it's been around 91% over the past 5 years. And so I think like keeping it flat and realizing that some years it'll go higher, some more years lower, I think is like okay. So we'll need to make another switch. Oh yeah, another thing I would do differently with this model in a real life scenario is like our switches probably should be somewhere different than like where all these cases are, but for our purposes, we will just keep it this way. So revenue switch, or actually, maybe so I'll keep it that way, but I think maybe we should copy the formatting at least. By the way, as I'm like doing this, quick plug, I started a MBA/corporate and a consulting and soon a banking meme page. If you go to my Instagram on Rare Liquid, I'm working with a team of pretty funny people to like consistently push out memes. And yeah, check them out if you want to kind of just like know more about like what the life is like for consultants and MBAs, but in like a funny way, essentially. Okay, so costs and OpEx, we also are going to need switches. I'm just moving them in this section here, like separately. Maybe it'd be, yeah, let's just do it like this. Okay. So we have switches now. Just need to connect to them. So offset, go to our switch. Oh crap, messed up. So offset, go to the cell you're referencing, which is the current cell. Then you go to your switch. Okay. Wow, I was not expecting this stream to be like one of the longer streams, but I think this is gonna end up being like 2.5 hours. Okay. So now we have our costs for insurance and other, and then railroad and energy. So this one, again, we go to our quarterly. We can rely on this 91%. And now it's a question of like how much, okay, so it used to be very, very just reliable, I guess, in lack of better words, or just consistent. And now it's ballooned to 91%. There's way more costs for whatever reason. And Why though? Pre-tax earnings fell by 59.5%. That makes sense. And 43% year to date with 2022. Pre-tax earnings were hurt by significantly lower fuel prices, as well as lower fuel sale volumes, while operating and interest expense rose. Okay. So what's happening is that because of the acquisition, this is affecting their margins. But what I just don't right now know is if what'll happen over time, because like I haven't studied the acquisition enough, and it would take forever to kind of do properly, and I don't even know if it's public information, like what the previous Pilot Travel Center's earnings were. Pilot Travel Centers. This ever, well, 45 billion revenue, it probably was a private company in the past. Yeah, okay, so let's just look into some filings. Pilot Travel. Pilot Travel Centers. Old ticker. Maybe was this like a European company? Not popping up. Let's try FactSet. What is this? Okay, right now, as this opens up, I'm gonna answer a few questions. Oh, actually opened up. But why do we create different cases? I'm guessing you meant to ask why do we create different cases, not just base cases, but you create different cases so that you have a range. Like valuation is not about finding one exact number that you believe a company should be bought or sold at, unless actually if you're maybe like a private equity company. But you're always looking at ranges to see like what should a company be valued at, if you believe like certain assumptions. But assumptions are so unreliable for the most part, right? Like you can have a ton of assumptions in a model and almost you're guaranteed for almost everything to be wrong or wrong as time comes. But if you have a range, you can just have like an idea of like what it will take for a company to be at a certain range, and give you like a sense of valuation and kind of go with what you believe, what kind of assumptions you think will be true. So that's why you have different cases. Okay, so Follows lower. Interest expenses rose. Okay, so this is what I think. I think this acquisition has made the railroad, utilities, and energy business for Berkshire Hathaway, it's made them less profitable. But over time, the company should get back closer to these margins. So I think in a base case scenario, what makes sense is kind of like going down to the average. And I think it might be a little optimistic, but yeah, it's a little optimistic. But we can kind of assume that eventually it'll grow to these margins again. So I'm going to just assume, and like it could also totally be that this is kind of an anomaly year and it goes back to what's that kind of normal in the future. But right now, sorry, I got distracted by the chat. Dare you to make a DCF model using Google Sheets? Yeah, I would totally hate that actually. And why is railroad, utilities, and energy in the cost and OpEx section? We're building, if you missed the beginning agenda where I explained things, we're going to be building out a revenue build and building out costs and OpEx and not just looking at the full line of what's given, although that would have made everything a lot easier. All right, so I'm going to grow this down to 80%, which is a little tad higher than, the historical. And then in the optimistic scenario, I'm going to just imagine it goes back down to its 5-year average. So that's the plan. Okay, so let's build out all of this stuff now. And I think it's going to be kind of similar to revenue. Okay, so conservative, we may use similar figures here. 2023, 2.5% higher. Optimistic, 2.5% lower. 2024, we won't need these actually. 2028, we're going to grow it down to 80%. Optimistic scenario, average of past 5 years, because it's been a pretty stable business and predictable. And then on the conservative side, I think what makes sense is let's get the difference of the base case plus the difference between our base minus our optimistic. Okay, so for 2023, 91% times 1 plus 2023, this assumption here. Oh, 93%, that's really high. I guess, it's just for 1 year. 1 year. Okay, and then conservative case, 81.9%, base case, 80%, optimistic case, 78.1%. I would honestly say that out of everything we've done so far, I feel least confident about what we're doing here for this section. And so this is where I would probably do some more research, but you know, don't have, whoa. Oops, I anchored the wrong section. So it should be that. Column should stay the same. Yeah, so I would do more research here if you're if you wanted to value this company on your own. For now, let's do this and then, you know, kind of get to our implied share price, see what everything turns out. And if I need to tweak something, like this is definitely an area to probably tweak. There's this random spam in the chat. Okay, so, all right. The hardest part is kind of over. So have our margins, total costs, and OpEx, and then percent margin. Add these two together. Okay, so where does this land us? The company was actually, I think it's more intuitive to look at EBIT. So EBIT is your operating profit. I think these numbers actually kind of make sense. So this is for reference, but we had a company that had an EBIT margin of 8, 12, 11, 6, 12%, 12% in the past. And then now currently with we're in our base case scenario, and we're kind of growing it around 10, like 12, 10, 11, 11, 12%. So it's growing to 12% over time. I think this is a little bit optimistic. We're basically assuming that the company will achieve its like pretty high EBIT growth, consistently pretty high EBIT margins, considering that over the past 5-6 years, its highest it's ever gone to was 12%. So actually this seems pretty optimistic, which I don't like. Let's see our conservative case for everything. Oh, what's going on? Conservative case makes it around 10, 9, 10, 11%, which is not that conservative. What do we feel something needs to be fixed. Okay, so this is going up 91%. Maybe this is too close to the average. Or, I mean, this is a lot lower than the historical average. I thought we were being somewhat conservative, but now it seems like we're being too optimistic. And I'm trying to figure out what is like driving this optimism. So let's go. Our revenue growth is pretty high. Then goes down to 3, which might be, it's around 2.5%, which I feel like is not like crazy. And then this is growing down to 2, which is also not that crazy. Margins around 90%. This is I mean, given 2023 is higher, 90% makes sense because it's near historical averages. This year is wild, but it's still higher than the average. Hmm. Eight, 12, 11, 6, 12, 12. Average is 10%. So our base case average is 11.4% versus 10%. So it looks up. I see a chat. It looks optimistic because we're growing revenue quite strongly while profit margin improves. Are we growing that strongly? 5%, 6% down to 2.5%. I mean, sure, I guess we can grow down, decrease our insurance to 2%. Our conservative case, 0.5%. And this one here, 3.5%. %6 on average growth, 5 down to 2. This doesn't seem too crazy. And then our margins, 86 going back to 90. Increasing margins. Maybe, well, for sure it seems, well, actually 90%. Okay, so our margins, I guess, if I do look at the average of this, it seems like maybe the margins are a little too optimistic. So it should be closer to 93%. So perhaps that is one thing we should change here. So instead of average of past 2 years, let's use the average of the last 6 years. And I know COVID, I guess COVID was a weird year, but something could happen again, right? So 93% feels somewhat fair. Increased by 1% here, or increased by 2.5%. 94%. Seems a little high. 92.5. 92. Actually, okay. Okay, and then here, 89 going down to 80%. I feel like this is already kind of conservative. All right, so now we're in our base case. It's 12%. Like, we know this year is going to be pretty high. Then it's 8, 9, 10, 10, 11. 10% equals average. Okay. This makes me feel better. So our base case is similar to the 6-year average. I think as long as our base case is like feels good, everything else, yeah, should be fine. Okay, so cool. All right, hard part over. Now, if we go to our agenda, we went through Berkshire situation overview, talked about Wall Street prep, revenue, and OpEx builds. We did that. Now we're going to do our DCF, and we kind of already did the historical based part, like order analysis. But I do need to gather the cash flow items. Go to our cash flow statement. So let me write down what we're looking for. Our DNA, so percent of sales, CapEx, also this as percent of sales, and then change in net working capital, percent of sales, and we also want to check our percent of change in sales. DNA, (2017). And then this is to total revenue. CapEx. All right, amazing. It's just 4% flat. CapEx. Oops, what am I doing? CapEx, purchases, equity, investments, blah, 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 blah. Financing. Oh, oops, what am I doing? Okay, CapEx, where is it? Purchases of plant, property, and equipment. 2017. You can anchor the row so that I can just copy paste this down. This will be and divide by total revenue. All right, amazing. It's just straight flat 5%, so it looks pretty just flat. It's easy to project. Change in net working capital. 2017. Go to here. Changes in operating assets and liabilities. And for this, we're going to look at percent of sales and then percent of change in sales. Computer's lagging. Okay. Huh. So change in net working capital is going to be weird. I'm just going to look at the cash flow statement again to make sure that not missing anything odd. Because Berkshire Hathaway is just honestly such a very unique company. Because it's just like, it doesn't focus on one thing. And they do a lot of financial engineering. Purchase of equity securities. Investments in Kraft Heinz. Okay. Okay, but nothing that affects your recurring free cash flow from what I can see here. All right. So changing net working capital will be a little weird to project, but I think, you know, the other stuff has been a lot crazier. So I think now we can just build the DCF. Here's revenue. It's a little bit repetitive what we're doing, but you know, it's good to just see all the figures. So EBIOT is earnings before interest after taxes, and then your D&A, percent of sales. CapEx. Basically, I can copy paste this. Yep, and then that's pretty much it. So now we have everything, so we can just link from here upwards. So we have revenue. Below that we have growth rate. Well, thank you, Sickleton, for that kind message. For Tesla, I kind of did try to make a revenue build for Tesla in the past, but pretty hard to do. And then honestly, at one point I gave up. So, oh shoot, we need our taxes. Okay, I'll just include it in this section. Oh, I hope their tax rates are not like crazy. Okay, interest expense. Okay, income tax expense / benefit. Just need to get this and divide by what their earnings before taxes is. So taxes, tax rate. Okay, let's just create a separate section for this. I want to show you guys good practice. Okay, so taxes, earnings before taxes. So taxes or earnings before taxes here. Income tax, oh wait, no, earnings of 46 or 56. Income tax expense slash benefit or earnings loss before income taxes. All right. Oh, dang it. Taxes. I feel like this number is going to be weird based on what I've saw. Tax expense slash benefit. So there's a huge tax benefit in 2017. Tax rate. This is weird. So they gained income. Should be negative. Oops. All right. So, this is gonna be a little tricky. Okay, I guess maybe not that tricky. I don't know exactly what they're doing, but it seems like Berkshire Hathaway, for whatever reason, has these huge tax benefits for whatever they did. They had these huge tax benefits. And so it was weird in 2017. Luckily, like what you want to see as you're modeling is like some sort of pattern, as I've been mentioning in this stream. And there seems like there's a few years where it's around like the corporate tax rate in the US, which should be around 19% right now, right? So, and then it was like 28% over here. These negative numbers are like tax benefits because it's a negative number, like, and everything in this model should be positive, right? And meaning that your costs here and all of these, I haven't made these negative, I made them all positive numbers. And then when I calculate like EBIT, I subtract the costs and expenses from the revenue, right? So these negative taxes mean that it's a benefit. I think basically what I'm going to try to do is rely on like these figures here. But let's also look at the quarterly. See what it looks like for 2023. Income tax expense slash benefit in earnings before. Okay, so we can calculate that here. Looks like there was a benefit for 1 year. Okay, so these numbers are just going to be quite odd. But let's see. Actually, for this, I might just need to calculate one figure. So taxes for tax rate for 9 months of 2023. Okay, I'm going to just see what it is. So I'm going to get the sum of the past 3 quarters. Earnings loss before, so income slash tax benefit. Divide this by earnings before taxes. That gets us our tax rate. I think what I'm just going to do is apply like a very standard tax rate. Oops. Messed up here. Okay, that's definitely wrong. Oh, oops, I have to add the sum function. %. So cool. 19% is around the corporate tax rate of the US right now. So it seems like in 2023, it's going to be around there. So we can just kind of use something around 20%. Let me just double check. I kind of forgot. Corporate tax rate, United States. 21%. Okay. So it should be around there. Okay. So let's color code these correctly to purple. EBOT is your, that's why we stopped here. We need to add our taxes. So we can link, but it's not exactly what we're going to be using. Dang it. Cool. All right, now we have our EBOT, which is our EBIT minus our taxes. DNA also up here. All right, kind of almost there. So now you can copy paste this down. For most of it, I'm gonna need to fix some of this, including our taxes here and this. Okay, so our revenue and EBIT, we've already calculated and everything, right? So they're all sensitized. That's why we spent so much time building out both of those. Our taxes and our cash flow items, we haven't yet. And for me, right now, around, I think it makes sense to just stay around the US corporate tax rate right now of 21%. Because that's what it seems like Berkshire has been paying for 4 out of like the past 5 years. So I'm not going to sensitize it. So I'm just going to, should I put this? This is kind of why it's usually good to have your taxes kind of like, or your assumptions in the different areas, because it could get like very long if you have a lot of assumptions. Okay, so tax rate, let's see. This is not just for the base case though, it's for all cases. I see a question of what you're doing, looking to do post MBA. I'm going to keep building out Rare Liquid, actually. So that's the plan. Sensitize means like adding flexibility in your model. So like these switches that we're building, like this is like sensitizing. Okay, wait, but where should I put this? Gonna have switches there, conservative. Kind of need like a section for like all cases. Now I'll have like operating assumptions. Okay, operating and cash flow assumptions. So we'll have taxes, we'll have DNA, CapEx, and change in net working capital. So taxes, we're just going to keep it as 21%. Corporate tax rate, similar to historicals, so I feel okay about that. Okay, anchor. Tax rate times our EBIT. That's our taxes. DNA and CapEx, we're just going to use a 5-year average because they're just, seems historically that's just, they're pretty stable. DNA's here. Okay. Curious to know if anyone has been here since the start of the stream, because it's been like 3 hours now. So, wait, has it? No, it's been 2.5 hours. If so, props to you. CapEx is there. Change in net working capital. Very wonky, because it's like 3%, 1, -8, -6, -7, 5, and then the change also does not help. Why is this so weird though? Oh, it's because these are weird. Okay. Just gonna use a 5-year average. It should be a. I don't know. I think we can't really predict this based on historicals, or like that's not the right way to put it. Like it's so wonky that we're using historicals to project, but we can't like create a trend based on what's here, right? Because it's trendless. So it seems like -3% was the average. Shouldn't affect our model too much. Okay, and we're just going to keep it flat as a simplifying assumption, because for the most part, these seem to be pretty stable. Though CapEx, I guess, a bit high. Yeah, actually, I'm going to use the past 3 years for DNA and CapEx. Generally, as you get bigger and bigger, your capex are kind of like lower. Oh wait, so let's see. F, G should be H. This should also be H. Cool. I'm going to make this red because it's an anomaly. Like these are being linked up there. This is like different, right? And then I'm going to link to this. I mean, you guys, I guess you don't really even need to see the actuals, right? We're just interested in historicals anyway, but so, actually, we don't even really need this information. I guess no, it's good to see. Okay, so we get our percent of sales. So, oops, we get our sales. Copy the row, multiply that by our percent of sales. What do I do? This is calculated, so we make it black. Okay. I guess what this is saying is that the company is pretty capital efficient. Because normally your change in net working capital, like it should be an outflow of cash, kind of. But in their case, maybe they have good terms with their suppliers or something. Okay, unlevered free cash flow. So our EBIT, earnings before interest after tax, plus our plus our DNA, minus our capex, minus our change in net working capital. Okay, unlevered free cash flow. Then we need our present value of free cash flow. This is where we need to calculate our WACC. So let's do that real quick. I'm gonna copy from our alphabet WACC page, since it's all pretty standard stuff. Okay, so 155, 60, okay. I'm just going to delete the yellow stuff. Actually, these are all values. All right. So this is our discount rate that we need to calculate. It should be pretty low for Berkshire Hathaway. I think like there's almost no point in calculating it, kind of, because it should be like 7 or 8%. Now, I guess the question is like, do we want to calculate it for Berkshire A or Berkshire B? I mean, I guess like it doesn't really matter. It's the same company, but we're just going to get to different share prices. I think given the fact that most people watching this, most people in the world would buy Berkshire B because it's just like, it's not $540,000 for one share. Let's do Berkshire B. I'm just going to, so market cap, 779 billion. Risk-free rate, 10-year treasury yield. $4.249. beta. $0.68, very low. Market risk premium. Go to Damodaran. So implied equity risk premium on December 1st, 2023 equals 4.25%. I believe this is right. So 4.25. Is this right? See, I thought equity risk premium was 5.94% on his website under data table. Let's see. Especially to compute current historical implied risk premium previous months. Okay, not that. Equity risk premium might be this. Market risk premium is different from the risk-free rate. Wait, what am I doing here? Market risk premium is your wow, I'm blanking out. Oh, it's your return. Well, actually, it's typically your standard return from your stock market minus your risk-free rate. What the heck is this? Okay, December 1st, 4.33% for, okay, now this T-bond rate, S&P 500, blah, blah, blah. Equity risk premium, trailing 12 months, what the heck? Smooth, normalized. Okay, equity risk premium, trailing 12 months, 4.53%. I guess I never realized that it was trailing 12 months. That's what we're supposed to use. Huh. But I guess that might be right. Oh, okay. Sorry. So 4.53 for trailing 12 months cash yield. This is trailing with adjusted payout. Honestly, I have no idea what that is. Trailing 12 months cash yield. All right. Derek Riles in the chat says it's 4.53% and seems very confident about it. With adjusted payout. Just trying to think. I see that it's probably one of these two numbers. Cash yield versus with adjusted payout, but what is being adjusted? Being paid out, maybe dividends? cash yield. Okay. For the stream's sake, I'm going to just go with the crowd / one person, which is Derek. But, you know, later if you want to change this in your model, totally feel free. 7.33% cost of equity. So that is your beta times your, or risk-free rate plus beta times market risk premium. Percentage of equity. So debt. I'll definitely look into the risk-free rate thing later, by the way, and add it as a comment, pinned comment, so that we have clarity on it. Right now, need to finish this stream. Okay, so let's see where debt they have. Loans and finance receivables, other receivables. Okay, so they have 23 billion, 23.144 billion in debt here. Plus maybe other debt. Wait a minute, these are assets. Oh, so these are, oops, sorry, ignore that. Liabilities and shareholders' equity, notes payable, and other borrowings. 41 billion in debt. Plus railroads, notes payable, 82 billion. So $124 billion in debt. I believe that should be it. Yes, okay. So percentage of debt is debt divided by debt plus your equity. 13.69%, okay. Percentage of equity is your equity divided by your equity plus your amount of debt. Cost of debt, always a little bit tricky, but it's actually like a lot of percentages here. Also could just look at your total interest expense. Sorry guys, honestly I'm getting a little tired. Okay, let's see, it's 257-ish. So 1.30. I mean, looks like around 2%. I'm going to make a shortcut. Honestly, we're not going to calculate this. I'm sorry. Okay, 2%. So what you can do if you have more time, if you want, you can get the total interest expense, find it in the income statement somewhere, or sorry, in the filing somewhere. Interest expense, and then find like the total principal or something like that, and then kind of just like get a weighted average. Tax rate, we have here That's 21%. Cool. So now we have our, oops, I was supposed to add this here. I guess you can just divide this by our total. And to answer the question in the chat, yes, this will be, the link will be updated to download this for free. But it'll be uploaded probably like tomorrow, Monday the 4th of December. Okay, so WACC, percentage of equity times cost of equity plus your percentage of debt times cost of debt times 1 minus your tax rate. 6.54. Okay. Pretty low. What if I did anything wrong? This is weird. This is lower than your cost of equity and lower than your percentage of debt, so I definitely did something wrong. Cost of equity times your percentage of equity plus your percentage of debt times your cost of debt times 1 minus the tax rate. Looks correct. I mean, you do get a... Oh, wait. Sorry. No, it does make sense. Okay. Because this is 2%, so this is super low. I mean, I guess you can make an argument that interest rates have risen, so you would not get these interest rates anymore. I'm looking to see like if recently they raised like what interest rate they got. So it's about repayment. I actually think I saw that they recently raised debt. So okay, it recently issued 74, 73, whatever in 0.955% senior notes due 2026. So what I'm thinking is if you take a weighted average, that would also kind of be wrong because that is their cost of debt in the past, but interest rates have risen quite a bit. You always expect Berkshire Hathaway to have pretty low interest expense on their debt because they're reliable, been around for a while. So I guess like these kind of make more sense. And it seems closer to 2.25%-ish. Okay. I guess that won't make a huge difference, but I just think the WACC should be a little bit higher. And I guess this market risk premium, as long as this is right, so 4 point. Oh, I guess it went down quite a bit over the past. Wait, no. Oops. Wait, hold on. 7.3%. Oh, sorry. Okay, now that makes sense. That's like I've just done so many WACCs recently for companies, and then their WACCs have been so much higher these days because interest rates have risen. Every company's cost of capital has gone up. So then I was expecting Berkshire Hathaway to be higher, but then their beta is 0.68. So that makes their cost of equity really low. So that's why their WACC is super low. And this all makes sense to me now. Okay. So now we're just going to need to add here. So we need to have a WACC switch and a terminal growth rate switch. So this will be for valuation, WACC. Terminal growth rate. So our WACC for our base case, let's just call it this one. And then for our conservative case, make it higher by 0.5%. It's honestly like pretty low. I think this should be our optimistic case. On even as low, or even as great of a company Berkshire is, 6.6% WACC is just like pretty insane. Okay, so base case 7.1%, conservative 7.6%, terminal growth rate 2.5%. No, 2%. Optimistic case 2.5%. Conservative 1.5%. Then I see a question on why do I just subtract or add 0.5%. It's just a simplifying assumption. Not really best practice. So here I'm just going to write other assumptions. For here we'll have our WACC, terminal growth rate. So equals choose your and then switch. That. Okay. Then I'm going to name this WACC. Name this TGR so we don't have to refer to it. Present value. We got to do our mid-year convention. So this is where we get our period. So then, how did I name this before? Look. All right, period and discount period. So technically this is like our first year, and then this is our second, third, fourth, etc. But given that we only have 1 month left or less in 2023, we don't want to take the full amount of cash flow from 2023, right? Because a lot of that is past, and your DCF is focused really on the future free cash flows. So we just want the last month, like 28 days or whatever, as of the filming of this stream, of this cash flow. So to do that, year frac date of today, and then I'm gonna use my mouse. Please work. Okay, so this is the number, this amount left in the year. Tricky thing about the first year is that you want to take, or so point of mid-year convention is that when you have your free cash flow as an actual company, you're getting your cash or losing it every day, right? If you were to have like a lemonade stand and you were getting customers, you would have cash flow. Let's say if you're in the green like every day of the year, if you're working every day. If you're Apple, you're selling products every day, etc. But when you discount back and you only use like end of year 2 or whatever, then you're assuming all that cash is received at the end of the year. And that just will make your valuation lower than it should be, because the more you're discounting into the future, then the more you're decreasing your value of that free cash flow. Maybe with some numbers, this all makes sense. But the point is, mid-year convention just assumes that you get your cash in the middle of each year, just as a simplifying assumption, because there's 6 months on either side of the year when you're getting it in the middle. So essentially what I'm saying is that instead of assuming that our cash flow should be discounted all the way until the end of 2024, we were basically want it on June 30th or July 1st of 2024. So to do that, and first of all, we do that for every year. So first, this current year here that we have 30, just a month of December left, we want to get it actually in the middle of December. So this we want to discount by 2 or divide by 2. I don't know why it does that, but then in order to get to our next year, what do we need to do? We need to get this number, our year frac, plus 0.5. So we do that because essentially this is asking like how many more years should we be discounting? And once we add this year frac of that number we had and add 0.5, this is adding 0.5 years. So this many years is what we need to get to end of 2023. Then we add 0.5 because we need 0.5 more months to get to June 30th, 2024. And then so from here, you add 1 because now you're getting 1 year later from here, which is June 30th, 2024. Then you add 1 year, then it's June 2025, et cetera, et cetera, et cetera. Now at this point, you could just add 1 for the rest. Okay, so now we can calculate our free cash flow. So it's our free cash flow figure times 1 plus your, free cash flow divided by 1 plus your WACC. Man, I thought I forgot the formula for a second. 1 plus your WACC to the power of the year that you're in. As you can see, the number doesn't change much, right? Oh wait, actually, this should be, we should take a, I think here, we need to take a percentage of this. So we need to take this number and use only a percentage times check something. interesting. What? What's happening? Zero. This is right. So I was just calculating, just testing out the formula. So this is basically saying there's 28 days left of the year, which is true. Okay, and I want to essentially use the cash flow that is times year frac. So this is the number of days left in this year divided by 365. So 8. That seems too low. So we should be getting 2,777. But for some reason, this formula is being super weird. So this is times, oh, wait, so times, no, that's right. The amount of days left in the year divided by, oh wait, no. It should just be this. Yeah, okay. Let me think if this is right then. So we have, discount period of 0.08. That means we want 0.08. Oh, this is divided by 2. So basically what we're saying is we want this discounted 14 days later this month, which is correct. Then we want it 0.58 later. Okay, so now I think this is all right. So as you can see, basically the discount is like barely anything. And as the years go on, it gets increasingly larger and larger. See, this difference here is 10 billion. Difference here is like 8 billion. Right, you can see it gets drastically larger over time. That's why if we made this, you know, plus one, everything, oh, what the heck? Sorry, plus 1. You can see the amount is like 11 billion, 9 billion, 6 billion, instead of 10 billion, 8 billion, etc. So that's why we use the mid-year convention. And now, okay, we're almost there. So now we need our terminal value, present value of terminal value. Then that gets us to our enterprise value. Then we need to add cash, subtract that. And this is what's interesting about this scenario. Oh, well, actually, sorry. Then we get your implied equity value. And then here, I think what makes sense is to actually add stock portfolio equity value, because company has a ton of in their stock portfolio. That gets to our total implied equity value. And I think I'll go into it a little bit later, but then we have our share count, and then we have our implied share price. So let's calculate everything out first. Terminal value equals your last year's free cash flow times 1 plus your terminal growth rate, all divided by your WACC minus your terminal growth rate. Then present value is your terminal value divided by 1 plus your WACC to the power of the last year. Enterprise value is sum of your present value of free cash flow and your present value of terminal value. 593 billion. So we can already tell this is less than, but actually once you add your cash, maybe we don't need to do this. So, okay, cash, I just know is a huge number. Cash and cash equivalents here, 25.573 billion. Plus 120 short-term investments in U.S. Treasury bills. Like they could technically sell this at any point. Investments in fixed maturities, equity, blah, blah, blah. Cash and cash equivalents here, 5.267 billion. Receivables. Okay, I think that's it. These figures are in, oh, I think I messed, let's see. These figures are in millions. This needs to also be in millions. Actually, I guess we didn't need those commas. So 157 billion. Then we've already calculated. That times 1,000. That's in billions. Okay, implied equity value, enterprise value plus your cash minus your debt. 626 billion. Okay, to be honest, I thought this number was going to be a lot lower because my view was, okay, so right now, where's FactSet? Company is valued at 779.3 billion. And my view is that we need to add the stock portfolio equity value. So why don't we just do that first? And I will kind of try to double check to see if this is correct. But we can see, or taking a step back and looking at the big picture of Berkshire Hathaway, the company obviously has its insurance and other, what do you call this, like business line, and then it has railroad, utility, and energy. But the company also is known for just having like this huge stock portfolio, right? And it's a huge investment in Apple and other companies. Like that is a huge part of the company's business. So, I mean, I guess you could kind of argue that for most companies that invest. But my thought was, if you go to like Berkshire Hathaway stock portfolio, should populate any moment. Okay, why is this lagging? What the heck? Annoying. This was working earlier. So, but basically you look at all these companies and you can see the kind of value of all the different stocks that Berkshire owns. The largest being Apple at 156 billion. And you can also see what the average price buy was, which is pretty crazy, right? They've been buying since $40 on average, and Apple's share price right now is like 192, so pretty good. But if you add all this up, it gets you to a certain number. Let's see. Oh, might be here. Oh, here we go. So the total value of their shares right now is 363 billion. And honestly, my thought was adding that to our implied equity value. And I guess that's not totally fair, because imagine that a company like Berkshire were to sell 100% of its Apple stock. As it sells, the company's share price would go down. So, and that's true for like all these companies. Whenever Warren Buffett makes like a sell or a buy, then all these, the stock prices just like fluctuate like crazy. So in some sense, you could argue this 363 billion, you can't just add, because this is based on the latest closing price. So then I guess that's like a little tricky, right? Do we just think about, not really sure what this is not what I expected. I mean, based on the company's operations alone, it seems like we got to around 626 billion. And I think a big part of that's probably because our WACC is pretty low. Oh, and wow, this is in our conservative case as well. So let's see. Go to our base case. Computer's lagging. Okay, so 871 billion. Interesting. I think the WACC is probably too low, but regardless, the stock portfolio equity value thing, I don't think makes any sense to include. Like, I'm wondering maybe if the stock portfolio is actually no, it's not included in the income statement. Well, okay, so thinking about the theory of DCFs, the whole point is based off a company's cash flow, and you don't necessarily, like, I've never in the past added like companies the value of their assets along with their cash flow in order to get to valuation. Maybe I was wrong in thinking that we should do that here. Like, I was thinking maybe, we'll get to really low enterprise value, and then what'll just make sense is that the company, you should value it based on its like portfolio as well. So I guess this is it. So share count 1.309 billion. 1.309 billion. Oh, this is gonna be really high. I think this is right. Okay, so this is obviously wrong. Fully diluted shares. So even if you did that, so market cap 779. Equals 779 divided by. Yeah. So Berkshire Hathaway has two classes of shares, one of which are Class A and one of Class B. I remember reading, so how many shares of Class A Berkshire convert to Class B? So one Class A share is converted to 1,500. So I believe what we should be doing is getting this, multiplying this by 1,500. Plus that. So we're in millions. So it should fight 507. That times 1,500. Is that right? So 570 million, blah, blah, blah. Okay, no, that's definitely wrong. Oh, wait, it was 571,000. Okay, and this is in millions, so this should be this much. There we go. $402. This is around what Berkshire is trading today. So that makes sense. Right. Share price for B is 357.07, and we're a little bit higher than that. Okay. So let's change this. 402.04. Let's agenda, stock portfolio valuation, price discussion. Like we kind of talked about stock portfolio, but I think I'm gonna have to look into this a bit post stream and think about whether or not it does make sense to somehow include this in your valuation, or we should treat like other companies we looked at in the past, whether it's like Alphabet, Microsoft, Amazon. All of those companies have made investments, but we have not included them as part of valuation, right? So also there's like non-controlling interest that I might not have included. Let me double check non-controlling. Okay, wait, let's just look at the okay, non-controlling interest, very small number. I'm not going to bother including it in this. Okay. So where does this leave us? Implied share price. Implied share price is 402.04. Current share price is 357.07. So implied upside slash downside. It seems like if we just believe our base case, then we think that Berkshire Hathaway has 13% upside from here. For me personally, let's think of to give you guys my thoughts about what I think the company might be worth. So insurance, what would I use? I would stick with base case revenue for insurance. I think that makes sense as well. For the most part, I'm okay with our base case assumptions, but I just think our WACC is a little bit too low. Actually, 7.1% is not bad. Okay. I mean, yeah, based on these figures, I actually feel pretty good about base case. Like, I think we could argue maybe like making this a bit more conservative. And you can like play around with these assumptions. Like, I guess I wouldn't want to go too much more optimistic than what we have. So what it seems like here is like on a conservative case, Berkshire could be around 289 billion. And then 19% of that implies 19% downside. So if Berkshire ever fell to like 289 or something like that, I would feel, and assuming nothing crazy happened to the business, then it'd be relatively like, I feel I have a decent margin of safety. And then if you believe the base case assumptions, then there's like around 13% upside. But personally for me, I wouldn't want to go a lot higher than this 13%. So like if you're an investor, then you might want to think, okay, I could potentially invest in Berkshire and get a 13% upside, but what else could I invest in and what upside could I potentially get, right? With that said, like you're also investing in a company that has a much lower beta, it's a lot more stable. And so that in itself is also nice because sure, some other company could have like 40% upside, but it could also have like 50% downside or 70%. So, and also like when you lose money, it gets harder and harder, like it's exponentially-ish harder to get that money back, right? Because when you lose 50%, you need to earn 100% to get that money back. Like you start with $100, you lose 50%, that's $50. Double that, you need 100% return, right? So the whole point of investing is actually risk mitigation versus focusing on gains. So that's why I wanted to bring that up because, you know, investing in safer companies does have a lot of benefits. Like losing 20%, gaining 20%, it's not the same thing. So that is the end of the building out everything. This was a pretty long stream. Thank you guys for tuning in. If you, especially if you watched somehow this whole thing, and I will have this Excel being able to, or you'll be able to download this Excel via the link below in the description. A day after this stream is published. If you guys have any questions, last questions in the chat, I'll answer them. While I talk to you guys as a friendly reminder about our sponsor for the video, Wall Street Prep, and they have this buy-side financial modeling course, which I'm going to take next year, and maybe I'll make a video eventually about like what I learned, and maybe my models will get better because you'd be learning from this guy named Brett Coffron. He worked at Maverick, DE Shaw Capital, Citadel, someone who's very just knowledgeable about hedge funds. And then you learn about like buy-side modeling. If you go down, there's like revenue build. You can look at these examples to see exactly what you learn. Forecasting, creating a price target, all that stuff. And you can see just like with each of these, like how detailed and how much you go through for all these different topics. So that's pretty much it for the stream. Let me pause to see if there are any questions in the chat. Do you think CFA helps one get into banking? I think it does provide you with a lot of knowledge, and in that way it does, but no one is going to look at a CFA. Actually, I think bankers will look at it a little bit and be like, okay, cool. Like this person probably knows like accounting and like all the basic financial stuff. So in that way, I think it'll help, but the vast majority of bankers get into banking without it. Can you make one where you start completely from scratch using 10K and not FactSet? Yeah, I guess in future I can do that. Barry, long time no see in the chat, I guess, for streams. But thank you for joining. Derek, CFA and CMT. Not really sure what CMT is. Okay, and then I also see something from Daniel earlier. You should use share of earnings, free cash flow from the top 5 positions. And you should think in something normalized. Okay, not really sure about what that means. On the job, do you use FactSet or 10K? You're always using both. You're always looking at FactSet, downloading information, and you always have to double check certain figures. And you're always looking into the filings for other information that you need. So for example, when you're calculating your fully diluted share count, you're not just pulling like what I did. I did a huge shortcut where I just pulled the number of shares from the cover of the 10Q. But in actuality, you need to calculate the potential dilution from the options, like warrants, all these like dilutive securities, and you get like a slightly higher diluted share count figure. So you need the filings for that. If you're working on a live deal and you want to make sure every single number is correct, you have to double check your numbers and hard code them in actually instead of using FactSet from the filings. Literally, like I used to, if I was like looking for this 2022 figure, I would not populate everything from FactSet. I would go into here, I'd go into the 10K. I would look like, okay, revenues, 2022, 249, 940, copy, paste, enter it there. I'd add and then I would add like 2022, 10K, page, whatever, or I'd like add this like link to it. This is why BAM-SC is so nice, but I don't have BAM-SC Pro. But anyway, that's what I used to do. So you do need the filings. That's my point. Okay, last question. What's my best step to go from my current 7-figure job to open my own investment fund? I'm pretty good at beating the benchmarks. Well, if you have a 7-figure job, why would you start an investment fund? You should just continue working at that job. Investing is so tough. And if that's not what you're doing already, then I think it'd just make more sense for you to, invest for fun if you're making that much money, and not like start a fund if that's not what you're experienced in. But anyway, thanks guys for joining. Really appreciate all of your guys' time and everything. And let me know if you have questions in the comments below, and I'll catch you all in the next stream. Thanks guys. See ya.